You are highly welcome to class. So in our today's session, we will be looking at accounting recordings, or we call it the journal entries. So a journal is simply a book, or we can call it a table or a document, which is used in recording accounting transactions in a chronological manner, right? So when we talk about chronological order, that means you have to be recording the transaction based on the way they are being carried out. So the transaction that they carry first, you don't have to take it and record after the transaction that comes second, or that comes third, or that comes fourth, and so on and so forth. So you have to be recording them according to the way they happened. So boom. So right in front of us here, we are having a question. We have some transactions that we are going to use our journal in order to record them. So looking beside all this, already a template of our journal that we are going to feed them there. So in order to record a transaction, one thing too that you have to do is that you need to identify which accounts are concerned in the transaction, which one is reducing and which one is increasing as well. We are just going to dive into this transaction and record them and move forward. So the first transaction goes thus. We have started a business on the 1st of January 20XX, started a business with capital of 20K. So in each of the transactions, you have to look which accounts are concerned. So we have what? We have the capital account is there. They say started a business. Though they did not specify that whether this money, if they started a business with 20K, that means this 20K is cash. So we have cash and we have capital. So the cash account from your accounting plan, if you check, you will see cash is a treasury account and treasury is class 5 of the OHADA plan. So we have cash. So our cash is going to increase, right? Oh, it's still starting, and the capital account is going to increase. So here, since cash is an asset, and assets increase on the debit side, while capital is a liability and liabilities increase on the credit side. Right, so here, this is our debits and credits. Debit and credit. So we are going to be writing the amounts, the account number here, the debited account here, and the credited account here, and then the amounts here as well. So here will be for their narrations or the details. Alright, so the first transaction goes, started a business with a capital of 20K. So we have cash is involved, which cash is 571, head office cash. Of cash, what's the amount? Of 20K. And then to the credit of 103, I think so, which is, so here I can give a bit of space. Personal capital amount 20K. Alright, so this is the first transaction. So when you record a transaction, it's always good to record to put there. So they say the date. We input the date there as well, please. So our first 20XX. So we have recorded this transaction. So if somebody just come here and see cash and capital, the person will not understand what the transaction is all about. So what we are going to do here is we are going to put a narration here. And the narration will be what? Start off capital. We say being start up capital. We are done with that. So the next transaction says on the 4th of January, purchases of goods. Sorry, this is on credit. 2nd of January. Purchase of goods. So when the accounts that they are concerned in this transaction, we have the purchase account and what? When we purchase goods on credit, that means we purchase from who? From our supplier. So we have the purchase account and the supplier account. So in this case, we have assumed that there was nothing like VAT. Take note. So in this condition, we have assumed that there was nothing as VAT. So purchase of goods on credit 10k. So we are going to debit account 601, which is purchases of goods. We'll put the amount 10k to the credit of account 411, which is our supplier, 10k. So we are owing the supplier. So being credit purchases. Right, let's jump to the next. The next transaction was on the 6th of January. Right, they say payment of supplier 8k. So we purchased 8k, 10k, and now we have not even paid the supplier complete, right? So payment of supplier 8k. So when we pay the supplier, what will happen? Meaning the accounts that they are concerned here were what? We have the supplier account and our means of payment. So this transaction they did not specify, but let's use cash. So payment of supplier by cash. So we are going to have, we debit now the supplier. We debit now the supplier 8,000 francs. And we'll credit our cash. £8,000. Sorry. 8k. So being can say partial payment of a supplier. Awesome. All right. The other transaction says on the 8th of January. Oh, sorry. On the 8th of January, on the 8th, purchase of office equipment 5,000 francs. So when we purchase good, we debit account 601. Now that we have purchased now office equipment, this one is a fixed asset. So the concept is that what? When we make purchases of fixed assets, we are going to debit by the fixed assets account and not the purchases account. When it comes to fixed asset, it is different. So we are going to debit office equipment account, fixed asset 2 something, or 244, I guess is 1. Please, you can confirm from your plan. So I have office equipment amount 5,000. Purchase of office equipment. So that the means of payment was not specified, but here everything we assume to be by cash. 571. Cash 5,000. Awesome. Narration. Being purchase of office equipment. All right, the next transaction, sales of goods on the 9th of January 20XX. They say sales of goods 12k, 12,000 francs. Right, says when we say cash coming by cash, so our cash will increase 571. by cash 12k to the credit of 701. That's income account. Oh, sales of goods 12k. That's awesome. So narration, sorry that is not one. So being cash sales of good. So thank you very much. This is the journal entry. So at this level we have to close our journal by drawing other horizontal lines here. So this is this for today, and we believe you have grabbed it. So thank you very much. If you want to be seeing more videos like this, feel free to drop your comments and also like the video and share as well. In such a way that we take transactions like this, do the journal entries. From the journal entries, we'll move to their T account to your trial balance. From the trial balance to the financial statement, which is the balance sheet, the income statement, and the statement of cash flow. So thank you very much for following. Stay tuned as we meet up in our next class. Cheers.